I think the one thing about venture is that there's no middle class. Most funds are either massively oversubscribed and find fundraising very straightforward or are really struggling. But then for a lot of people, you don't have that. It can be very, very, very tough. Venture is a really interesting asset class where it's not just up to a VC deciding which founder do I want to invest in. They have to convince the founder to work with them. If you find one of these generational founders and you've got other tier one investors sitting around the table with term sheets, why do they want to work with you?
Hi everyone, welcome to 23 Mile with me, Kayode Odeleye. One of the biggest blind spots for tech founders is understanding how the venture model actually works. My guest today is Sion Evans, who operates at the very top of the capital stack as an LP who picks the VCs, who picks the founders. Sion is an investment director at VenCap, one of the oldest fund of funds in the industry. Founded in 1987, VenCap manages over $2 billion and has made more than 500 commitments to VC funds across the US, Europe, China, and India. Their portfolio has exposures at world-class startups like Google, Facebook, Airbnb, Stripe, and ByteDance. What makes Sion's perspective unique is VenCap's approach. They maintain just 12 core manager relationships, obsessively focused on accessing the top 1% of exits that drive the majority of venture returns. Sion joined VenCap 10 years ago after spotting a vaguely worded job ad for technology investing based in Oxford. He since built deep relationships with the world's top-tier VC firms. Sion, welcome to the show.
Thanks a lot, Kurt. It's great to be here.
Cool. Let's start. Let's dive straight in. According to PageBook data, 2025 is on track to be one of the lowest fundraising years on record for VCs. What's driving this trend?
Yeah, it's never easy to raise money. It does feel more difficult than normal in this current market. But I think the one thing about venture is that there's no middle class. Most funds are either massively oversubscribed and find fundraising very straightforward, or are really struggling. I think lots of the managers that do find it straightforward do so because they've really earned that right in terms of their performance. But then for a lot of people, you don't have that. It can be very, very, very tough. Lots of people talk about the lack of exits, the lack of liquidity in the market, not just from venture, interestingly, but from the broader private equity portfolio. If your private markets portfolio is 80% buyouts and you're not getting any liquidity there, there's less money to make new commitments to the venture market. I think the different question is whether this is a good or a bad thing, because it's not always so obvious. I mean, if you're struggling to raise a VC fund, maybe you'll see this is definitely bad. But from our seat as an LP, we saw an explosion of funds get raised over 2020, 2021. Lots of them, fairly undifferentiated. And when you've got too many people chasing too few opportunities, that doesn't necessarily correlate with great returns. So, for me, it's not just about looking at, how difficult has it been the last few years, but it's looking at what's the total amount raised or the total of funds raised versus the long-term average, especially sort of the pre-2020 period.
You raised some great points there. The 45 billion lower this year brings the average to what it was, I'll say, before 2020. But to a point you raised there, which is focused on what really matters, the exit returns for investors. We are also dealing with the fallout of the massive explosion post-2021. That hasn't finished playing out, has it?
No, I don't think so. I think what you saw after 2021 is, for some companies, that will be their global high in terms of their valuation. We've seen some companies in our portfolio, like take Databricks as a great example. They've not only carried on growing, but are able to go on to raise additional capital in the private markets at higher valuations than they did at the top of the 2021 environment. Something like a Revolut would be in the same bucket, where have just really accelerated, and these are some of the very best businesses in the world. Some companies are talking about still trying to grow into those valuations. Some of them no longer have explosive growth. Those companies are in a very different sort of environment. And if you're a software business and you're suddenly no longer growing and you're not wildly profitable, it's very hard to be valued at the sort of 20 times revenue you thought you were going to get when you raised that last private round. So I think one interesting thing to note is that even though that hasn't fully played out in terms of the companies, either whether it's finding an exit or raising the next round or whatever comes next in their journey, from our seat as a fund of fund, we do see the impact of that fairly early. So most of our managers took proactive write-downs in 2022 because the public market comps radically changed. So they said, look, we're going to write these down in our books. I mean, part of that is a virtue of, finding it very straightforwardly to raise capital, because you don't need to show those unrealized gains in order to, raise your next fund. If you know that's already very concrete, then you can say, look, we're going to try and reflect reality here, even though it's, in the absence of an actual fundraising round or an exit.
Touching on that point, let's talk about the fund of funds. A lot of investors, the VCs, know what a fund of fund is, but the founders listening to this would can't see beyond their nose, so to speak. Tell us in a nutshell, what is an LP, what is a fund of fund, and where does VenCap sit in that space?
Yeah, so I know other people have sort of called it the money behind the money from a founder's perspective. So really simply, we raise a pool of capital, much like a VC would, but instead of investing in startups and in founders, we invest in VCs. So again, if you're thinking about if you're raising money from a VC, who gives them their money, the answer could be someone like us. We sit in Oxford, we have a global portfolio, we have our own strategy, and you'll find that there will be fund of funds all over the world, some of them with focuses on different sectors or on emerging managers or on different geographies. So there's a wide variety of flavors out there. We, for example, focus on more established managers with proven track records and ability to access those sort of companies like a Databricks or a Revolut. But it is all a nice part of the ecosystem alongside people like pension funds or family offices or other institutional investors, endowments and foundations that would look to put their capital to work over the long term with venture funds.
I mean, and VenCap has been going on for almost 40 years. What would you say is key to this longevity in the space?
Good question. I think a lot of it is focus. It's sort of focus, and it's the long-term relationships we want to bring, not just with the VCs that we invest in, but also the people that invest with us. So venture is all about relationships, really. The funds that we invest in have very long time horizons, normally over a decade. So again, it's hard to understate just how important those relationships are. And then the other bit for us is we're only focused on venture. We're not trying to do other things. There's lots of really other interesting parts of the investment landscape, but they're not for us. So focus is really important, and that lets us be really consistent over a long period of time. So, we talk about our strategy today and the fact that we really got onto it, in the aftermath of the financial crisis. So we've got really 15 years of consistently doing the same sort of type of thing day in, day out. And that's really important in this business because feedback loops are so long in venture. I've been at VenCap for just over a decade now, and some of the funds that I was investing in when I first started, we're only now finding out, were we right? Were they going to be successful or not? Which is a little bit scary when you think about the money that's been put to work today. But again, being consistent and being focused just really helps.
And thanks for that, Sean. How do you think of focus looking down into the GPs and then from the GPs into the founders? Is focus one of the things you screen GPs with when thinking of investing in them?
Yeah, it's interesting in how you define focus, actually. So all the managers we back, for example, are generalists in terms of sector.
Okay.
And then the reason we like that is because we don't think we can pick a sector as an LP. So, in our day job, we do speak to VCs quite a bit. We don't spend all our time speaking to founders, or almost any of our time speaking to founders. And we especially don't spend our time speaking to the world's very, very best founders, the ones that can drive those top 1% exits. So really for us, we probably won't have any idea of where the best sector is to invest at any given time. We even joke internally that, if it's obvious to us, it's probably 3 to 5 years too late. And, we've got funny meeting notes going back decades where we saw Facebook in 2005, we saw Uber just after it launched, and, more recently things like OpenAI. We had no idea. We were lucky to have exposure to one of the very first rounds of OpenAI, and for us, it took 3 years before ChatGPT launched, and then we said, "Oh, okay, we can see why this might make sense." But then there's a good reason we're sitting in the LP seat, not the VC seat.
Amazing. So what I hear is your focus as an LP is picking the right VCs who have access to the very, very top founders. How would you describe that selection criteria? Either as an emerging manager, as a founder, how would you describe to them what does a top VC look like?
Yeah, I think a lot of what we look for is sort of less about what people say and more about what they've done. And for us, there's no one way to be a VC. We're invested in some firms who are small, equal partnerships, got a very boutique sort of feel. We're invested in some funds that are machines. They are large platforms. They have hundreds of people on staff, and they play the venture game very, very differently. It's possible for all these models to work really well and to not. We've seen both instances on all sides. So the key thing that matters for us is, do the best founders in the world want to work with you? Have you earned that right? Because venture is a really interesting asset class where it's not just up to a VC deciding which founder do I want to invest in. They have to convince the founder to work with them. People have been talking a lot on Twitter recently, over the last sort of year or so, about venture being maybe more efficient at the Series A than people imagine, especially in the US. So again, at that point, if you find one of these generational founders and you've got other tier one investors sitting around the table with term sheets, why do they want to work with you? And again, everyone will have a slide about their edge or their proprietary deal flow. For my money, that's not really worth anything. For us, it's saying, show us the portfolio, show us those founders that chose to take your money, and do that over time. So again, that tends to exclude 99% of the venture market, which does make my life a little bit easier.
Good to hear that. But I'm sure a lot of the emerging managers are thinking, "Oh, I can't get it." We'll come back around to that, but there's something you mentioned earlier around the long-term nature of venture. Honestly, I started off in venture 5 years ago, and it took maybe 2 years to understand how long-term this can be. For founders who are starting off on the journey, how should they be thinking about building a venture, considering it could be 12, 13, 15 years to seeing the full scale results and exit?
Yeah, I think, one thing I've heard that stuck with me is that when it comes to starting a company, you shouldn't do it because you want to do it. You should do it because you have to do it.
Very interesting.
It's extremely hard thing to do. And again, remember that I'm in an LP seat, so I am very far removed from the actual work getting done day to day of building a company. We're sort of sitting. Some people think that VCs are far away from that work, but imagine how far we are. So you have a lot of respect for people going on that journey, because it is a long journey and it's really hard. So again, you have to need to do it. If you're just thinking about this as a career option where, this might be fun for a little bit, this might be a way to make some money, I imagine that would make it a very challenging thing to see these things through. Even the very best startups have near-death experiences. They have times where it looks like everything's going wrong, and those are the ones that work. I had a friend of mine in San Francisco who's a VC, and he was told, as 2021 turned into 2022, one of his senior partners told him, "Look, the last couple of years you've been funding your friends. Now you're going to be firing your friends," which is maybe a little bit glib, but it's a tough business. So if you think about that from a founder's point of view, this might have gone from you're raising rounds, you've got great growth, you're hiring people. If that turns, you might be firing people, and you might be downsizing, and you might be trying to stay alive. And again, so much respect for people that go on that journey.
I'm interested. You touched on something there which takes on to the power law, which I think everyone in venture basically knows what it is, but it's just that idea that maybe the top 20% drive 80% of the returns, or even for venture, perhaps more concentrated than that. From what you described around working with very, very select VCs, it definitely seems there's a power law for founders of startups, which VCs look for, and then there's a power law as well, which the very top firms drive most of the returns. Is that the case that the power law goes all the way up from founders to GPs to LPs?
Yeah, I think that's exactly right. And it might have a different slope of that sort of power law curve depending on what level you go to. But it's definitely true. So again, if you look at any of the industry level data, whether it's from PitchBook or Cambridge Associates, or now there's really good data coming out from Carter, industry level returns in venture are pretty bad. Just straight up bad. If you're getting the median venture return, however you slice it, that's probably not great, and it's definitely not worth the risk and the illiquidity you're taking on. One way to look at it is look at like the long-term, benchmarks for DPI. Have a look how often the top quartile has been above 3x. It's really tough out there.
Yeah.
The sort of flip side is that you sort of see if a fund hits one of these generational companies in a material way, if you are an early investor, going back the Googles or the Facebooks of the world today, an OpenAI, a Databricks, a Revolut, a Stripe, those individual funds will be generational returns. So you do see that really quite severe power law. The really interesting thing is we find with lots of the very best firms is just how high the floor is on performance. And I think that's a less sexy way of talking about it, because rather than talking about, our best fund is over 10x, this is a great anecdote. But if your worst fund is 2.5x, that's a really good place to be. And what we see with lots of our funds and lots of our managers is that they're consistently hitting a roughly that sort of 3x mark. And if things go right, they go north of 5x. That's a really interesting distribution for me to be sitting in as an investor, because suddenly you're sort of capping a lot of the downside that goes along with the venture asset class while maintaining lots of that convexity on the upside when things go really right. This is a very different profile to saying, look, if we were picking emerging managers, and I don't do that, so take this with a pinch of salt, I imagine there'd be much higher distribution or variance in the returns. The dispersion would be much higher, where you've probably got more chance of hitting things that are north of 10x. I think the very best performing fund in every vintage absolutely will be a small emerging seed manager, but then the downside risk of the losing capital is also much higher. Again, the power law is always there, it's just probably got different shapes.
Very interesting. You talked about the floor on performance. What does that look like? Let's look at it first from the GP's point of view. What do you, from your point of view, seated again above that, what do you see that are the best managers that are able to cap the floor performance at, like I said, the 2-3x? What do you see that they do right to be able to maintain that floor performance whilst keeping the upside? What do they do right?
Yeah, I think the interesting thing for me, and again, this wasn't obvious sort of when I started the job, is that where that floor in performance comes from, it's not from managing downside, it's for focusing on upside. So, even the funds that do exceptionally well, say north of 3x net for us, which would be our measure, they generally lose money on 50 to 60% of their deals at the early stage. I think, the long-term average, we expect it to get up to around 60%. So again, you're losing money on the majority of your deals, but often it's one or two hit so well that they make up for everything else. One of the key metrics that we look for is a fund returner, which is one investment returning at least the entire committed capital of the fund. So that's really sort of what drives that performance on the upside. And then on the downside, it's something similar. If you're a 2x net fund, which may have relatively underperformed, but okay, let's take a look at that. Maybe the loss ratio might be a little bit higher, but it's still going to be having a couple of winners that maybe they return a quarter of the fund or half the fund. It's still dictated by what's the size of your biggest winners. So the most important thing for those managers that can generate consistent performance is, even in their relative down years, they're still accessing companies which for most VCs would be a generational deal. These are often multi-billion-dollar exits, and either it wasn't as big as you expected, or your ownership wasn't quite high enough, or you got in at a slightly too high valuation. Whatever the reason is that it didn't work out the way you maybe planned, in day one, you're still accessing really great companies, and this is why venture is probably so tough on the industry-wide model, is that there's only a few of those companies globally. So again, if you don't have access to them, it can be a really tough asset class.
Very interesting. So I've spent a lot of time looking at, that power law distribution. 60% failing, but then the VCs hopefully hitting a home run with one of the other ones. What does that look like from from the funds to the LP? Do you generally have some funds, say some managers having funds that failed? Do you ever have funds in your portfolio that actually just can't return any capital at all, or based on your selection criteria, is there, like, again, using that word, is there like a flaw on the kind of returns you get as LPs?
So to give you an idea, from our current group of 12, what we call our core managers, we've invested in over 100 of their funds going back to the late 1980s. So it's a very long time period. And cutting it off at 2020 because, we're ignoring funds that are either just being deployed now or in the J curve. The lower quartile cutoff is roughly around 1.6 times.
Wow.
And I think the lower decile, last time I looked, is sort of 1.2, 1.3. So in terms of like things that are not working, you do have that flaw where you're still making a positive return. It might be disappointing relatively. Some of these might be 2020 vintage funds or 2019 that are still maturing. So there's always some nuance in the data. But generally for us, for the top managers, the floor is reasonably high. You're still making money. Having said that, we've backed over 500 funds over almost 40 years. We have seen plenty of funds that have failed to return capital, like failed to get to 1x. We've seen some that have, probably would be almost rounding down to 0x. Like we've seen these, and again, these are all ones that have gone through an institutional due diligence process. But especially before we really tightened up our strategy, and there's a lot more variety in who we were backing. You see these sort of things. Like everyone who's been doing venture for a while has got all these anecdotes about, whether it's crazy behaviors or it's I've seen people distribute private stock to wind up a fund. That's not a fun place to be. Again, it's nice when things are going well, but when venture goes badly, it can be a tough place.
Nice, and thanks for that. You've mentioned it very clearly that VenCap is focused on the very top end. But just would like to get your perspective for the benefits of the smaller funds, the emerging managers. That fundraising environment for those type of funds now is pretty dead. If you were sitting across, or if there were an emerging manager listening to this, how would you advise them to go about the broad fundraising attempt? Not to VenCap because they can't, but how would you advise them to tackle the fundraising market?
Yeah, I think it's worth sort of being quite introspective and thinking, what's your reason for existing? To be quite candid and to be clear, we do the same thing at VenCap. We have to go and raise money from our investors. We don't have any, God-given right to exist. If we didn't offer anything compelling to our investors, they wouldn't give us any money, and that would be that. So again, we sort of do massively empathise with people on the fundraising journey as people that have to raise capital ourselves. So being really clear on why you should exist in a marketplace, and then doing your best to try and prove out those proof points, because I mentioned that maybe a slide showing this is our edge or anything else, it might not really be worth anything. So think about how you can sort of back up what you're saying with data. If you're raising a first-time fund, you might not have the data, but maybe you've got anecdotes that are quite powerful, whether it's references from founders, maybe it's your angel track record, but some sort of way to try and substantiate what you're saying, I think is really important. So again, I don't invest in emerging managers, so there'll be other people that do that can sort of speak to that much more usefully and eloquently than I can. But just some sort of basic things that lessons that we try and implement ourselves is saying I would recommend.
I mean, there's something I'm going to borrow from what an answer you'd given for the founders, which I think it's relevant here. So tell me if I'm right or not. It's basically that fact that don't start a business, don't start a startup, effectively don't start a fund as well because you want to, only start it because you have to.
Yeah.
Kind of seems
I think that's pretty. I'd say exactly the same thing applies. I know people. Just today I saw a chart someone re-shared it on LinkedIn, looking at I think it was VC salaries across different, or the median VC salary by different fund sizes, and I think the high end is always very high. Yeah. I think if you're at the smaller end, you're probably going to make more money working for one of the Mag 7 especially in the short term, by doing that. And again, I'd also think about, if you're looking at this as, is this just an interesting thing to do? If things go right, like carried interest dollars can be very significant. If you look at the industry average performance, you have to think, why will I be doing significantly better than this? I think that same advice as do it because you have to is probably good ones for VCs as well.
Thanks for that. For my business, I will bear that in mind. You said something earlier on around relationships and trends in the space. There's a new Wall Street Journal article that came out recently, and recently that eyebrows have been raised on Twitter around storytelling. I hear startups are hiring storytelling heads of storytelling now, which who knows what the difference is between marketing and that. But it points to something I think is a fact, which is a lot of founders, a lot of funds, and I think LPs as well are going direct to the audience. How important do you think this is in building within the space?
Yeah, I think people have, shown just how powerful it can be by going direct. I sort of think about people like, Harry Stebbings is a great example.
Yes.
Through his podcasts and his general activity on there, he has gone direct, and he's turned it into, something quite phenomenal, to sort of be honest with you. I think having something like that to say and going direct can be really powerful. Again, I sort of think it also comes back to, do you have something authentic to say? Again, this is something that we sort of think about at VenCap. So we've been much more active in probably the last couple of years of sharing some of our research and our data either on LinkedIn or on Twitter. So again, do check it out if you want to see some of the data sort of backing up some of the things I'm saying. But for us, it's sort of very important just to say, look, we want to say something directly that we truly believe in and that we think people might find interesting, because data is quite hard to come by in venture. We spend all our days thinking about data alongside the relationship, so maybe this is something good to share. I think if we went up with a different strategy that wasn't, not unique to us, but then wasn't really a reflection of the people you've got at VenCap, it probably wouldn't work so well. So again, I think it is something that's quite powerful if you do it properly.
Thanks so much, Sean. Let's move on to exits, which I will say is definitely the most important thing in the space, to founders, to GPs, to LPs. So from available data, seems we are at, I want to say historical lows, but I'm probably not looking at it long enough. But we're in kind of low period in terms of exits. How are you seeing this from a VenCap and an LP point of view?
So the interesting thing for us is that it doesn't feel like that at all from our seat. And part of the reason I say that is that we've had one of the best years of exits we've had in a long time, and 2020, 2021 were off the chart good. So if you sort of take those out from the long-term average, we'd be really happy with the exits we've had this year relative to most other vintage years, to be honest. Part of that is we've been lucky that our VCs are giving us exposure to those, top 1% exits that really matter. So we've had listings from the likes of Figma, from Circle, from Navan. I think we had Wealthfront go a few days ago. We had a couple of others which have been quite nice. We had the sort of quasi sort of transaction with Scale, where Meta sort of acquired about half the business there. We had very significant exposure to that one, and we've also got very significant exposure to Wiz, which was the largest ever VC-backed M&A when Google bought it for $32 billion. That's still going through antitrust. I think it's expected to close next year, which again I saw it got cleared in the US, which is a nice step forward. But those sort of companies, those are the ones that are driving industry level liquidity, and those are the ones that are driving liquidity in our portfolio. So I always wish we had more IPOs. I think we've got some of our older vehicles. We've got lots of exposure to great companies like a Stripe or a Xiaohongshu or a ByteDance out of China. Things like Databricks also out of the US, Revolut in Europe. Some of those companies were to go public next year. That would be great. I mean, we're hearing rumors that SpaceX, OpenAI, Anthropic, some of these titans could be going next year. We've got pretty significant exposure to all of those three. If even one of those were to go, I think people start to call them the private Mag 7, then maybe next year could be even better.
Very interesting. I mean, like it goes way back to what we said at the beginning as well around the VenCap strategy of investing in top 1%. I mean, I hear you on what it looks like for you. You're saying that because at the other end, for the other 99%, it seems there's a lack of liquidity. On that point as well, what about secondaries? Do you see a lot of secondary activity with the funds you're invested in?
Yeah, so secondaries just feels like it's become a much bigger part of the market over the last few years. And that's on sort of all levels. So we're seeing our managers being quite aggressive in buying secondaries in companies. So, they have to fight tooth and nail to get as many dollars as they can into these companies. Like I said, things are very competitive for the very best founders and the very best companies. So if you can invest, in their Series A or the Series B and then buy some secondary from whether it's from an angel or from employees, that's become very popular. Lots of those, private Mag 7 type companies are holding more tender offers. So that's another way to get more capital into the companies. We don't play there. We let our managers go directly to the companies. Where we're much more active is sort of buying positions in funds, sort of the LP-led secondary market. It's something that we've always done, but it feels like as a space it's matured quite a lot in the venture ecosystem the last couple of years. It's now starting to trend much more to the way it is in the buyout fund, where it's a normal part of managing your portfolio, as opposed to being something that happens every so often for someone that's really distressed in the market or something that's frowned upon. So that has a lot of really interesting opportunities. And then again, for us, we sort of treat that as something where if there's a fund or a portfolio where we can access some of those potential top 1% companies, the ones that we've been maybe following for a long time that we really want to maximize our exposure to, this can be a really interesting way to play it. And also knowing the fact that because we've got so much data from so many different managers in these companies, we're often in a very almost unique, not quite, but almost unique way to be able to price some of these transactions. Because again, venture's really opaque. If someone offered me a piece in a fund that I'm not invested in and I don't have any of the data, it's almost impossible to sort of come up with a fair price for that. So again, lots of really interesting opportunities there, and something that probably has picked up over the last 3 or 4 years against the backdrop of, despite us having a very good year this year, maybe the lack of industry level liquidity compared to what people were hoping for.
Okay, and thanks for that. You touched on distress very briefly there, which brings me on to, I would say, relatively new or strategies like distress investing, AI roll-ups, and maybe the biggest splash has been made by Bending Spoon, which has been spending a lot of money buying, I would say, old tired brands and rolling them up under its umbrella. How do you see all this, I will say, alternative VC strategies?
Honestly, we don't think about it too much. So we have, some of our managers will go and do transactions that are not straight down the fairway venture deals. So it's not just a Series A, Series B, Series C, whether it's like an AI style roll up, whether it's some sort of take private. There's always little things around the edges that happen. And I think really, again, we sort of trust our managers to sort of take those opportunities where they are. But then for none of them is it a core part of the strategy. So if one of our managers said, look, in this fund, it's mostly the sort of typical venture deals as aligned with our strategy, but there's a venture roll-up in there, or we found some legacy business we think we can do a Bending Spoon type transaction in, or anything else, like generally we're quite positive there, because generally there's really good alignment in venture. Our managers are very motivated by carry. They've got their own commitments to the funds. They're often the most hyper competitive people you can ever come across. It doesn't get talked about enough in venture, but these people want to perform well, not just for the monetary bits. Some people in our portfolio are very much post-economic, but they do it for the love of it. So I think we trust them to do that. And then the last thing we ever want to be as an LP is sort of too prescriptive, as long as we trust the manager to make that judgment.
Talking about boom and bust cycles again. It seems in 2021 there was a boom, there was the bubble there, which was preparing to bust until the AI, the LLM powered boom came on board. But it seems like that there are inflated valuations in the market right now. How do you see this playing out with the SaaS boom, which hasn't fully deflated, and then now the AI bubble? How do you see it play out?
Yeah, I think we've already pushed back quite a bit on the B word, on the bubble in AI. I know my colleague David Clark has just sort of actually released a short white paper, so go check it out on our LinkedIn page about looking to see if basically saying that a bubble is a very specific set of characteristics. Often there's lots of retail participation. There's lots of people building out supply well ahead of demand, and all these other sort of characteristics. And that's really not what we're seeing today in AI. The valuations are absolutely frothy. They're absolutely high in relative terms compared to what you saw in SaaS. But a lot of that is because of the fundamentals that we're seeing. So, for a while there was a chart showing, the amount of time to go to $100 million of revenue. It was almost an order of magnitude quicker for the top AI companies than it was for, SaaS. I remember charts going around showing how quickly Cursor got to 100 million, and then people started showing the same chart but said, "Oh, Cursor's slow compared to Lovable." Now they're talking about, Cursor's just announced it's reached $1 billion in ARR. I'm sure other ones will join it soon. And if you look at some of the large language models themselves, suddenly you're talking about adding $1 billion of ARR or revenue in a quarter or in a month. And again, the rates are like nothing we've ever seen. So I think for some of those companies, it's sort of taking into account the valuations relative to the growth rate. Whereas if the growth rates continue the way those investors believe that they will, they could end up looking very cheap in short order. If you sort of think that there could be a reversion or a slowing of that growth, like we saw with, a great example would be the sort of online events companies over COVID. Everyone started living online. A lot of that revenue growth got pulled forward. You saw astronomical growth rates, and then the world reopened, and then that all unwound quite rapidly. There's still people recovering from a little bit of whiplash there. If you think that same thing will happen in AI, maybe those valuations do look frothy. Personally, I think this is probably one of the biggest platform shifts we've ever seen in the industry. And this is sort of talking about it. People are not only talking about it relative to things like the internet or mobile or cloud, they're talking about steel. So again, if that is to happen, then these valuations will look very sane. I think with things like an OpenAI or an Anthropic specifically, lots of the people that are backing these companies see a very straight shot at these becoming Mag 7 type public companies in terms of valuation, in terms of revenue, and also importantly, profit. Because again, a lot is sort of talked about what's the margin, what's the long-term margin, is there any profitability there? But again, there's a long way to go for you to execute on that vision. But people that are backing the OpenAI at 500, the rumored Anthropic at 350, they are seeing that path to execute to become a multi-trillion-dollar business with the sort of revenue and profit scale of a Google or a Facebook today. So again, it makes it quite an interesting environment. And I'm based in the UK. Every time I go out to San Francisco, it just sort of blows your mind just how quickly things are happening. So yeah, it feels like it's such a dynamic place today, even relative to the normal pretty high bar for dynamism in the sort of venture tech ecosystem.
Thanks for that. You mentioned that UK San Francisco corridor there, which brings me to my next question around the UK. I mean, the UK is, I will say, historically been a leader in the tech space, but it seems, you touched on Lovable, there are a couple of European players in that AI space, but it seems that over the past few years, the gap between the US and the rest of the world in venture is only widening. How do you see that playing out? How do you see the UK possibly closing that gap in becoming a more prominent player in venture?
I think the nice thing already is that I think the level of ambition in UK founders has changed pretty significantly. And what I mean by that is, if you're building in San Francisco, everyone's sort of assuming that you're building for the world and that you're going to be the global number one player. If you're number one in the US, there's a chance you're very far on that journey anyway, just given the size of the domestic market. But I think now in the UK, and this probably applies to all of Europe, people are going global quicker and quicker, and people are, everyone's talking about global maxima, not local maxima. So if you're building a startup and you want to be part of that top 1%, you're going to be competing with startups from all over the world very, very quickly, which means that the level of competition for your business has gone up significantly, but the size of the prize has also gone up significantly as well. I think something like maybe a Revolut would be a good example of this. They've got no ambitions to be just the number one player in the UK in neobanking and then call it a day. I think they're very much set on world domination. Again, we don't talk to these businesses specifically, but it's sort of quite clear that they're not limited by ambition, and they've shown, them specifically, they've been able to execute on that ambition at just an absolutely incredible level. So I think we're sort of seeing that, and part of the way we sort of feel validated in that sort of thesis is that we're increasingly seeing our managers from the US come over and back companies in the UK or Europe at the very early stage. I'm talking sort of Series A deals or sometimes at the seed. And for them, if they see someone in a particular category, maybe a vertical AI application as an example, they want to back the best company globally because they say, look, that's the one that's going to win. If I back the best company from San Francisco in this application, but it's someone from London or Stockholm or Berlin that wins the category, then I lose. So again, we're sort of seeing more and more of that, where people are going global to look for the very best opportunities, and some of those ones that they pick are in the UK. So I think that is the key thing. It's just that level of ambition is raised, and again, that makes it probably a harder road, at least in the sort of short and the medium term, to walk. But again, the upside is being a globally significant company.
Thanks for that. So fingers crossed, rooting for UK founders to be able to compete with the world's best. Looking back to the start of your career, you started off in the private bank codes, and then you in your own words, you kind of stumbled on a job ad, and you ended up at VenCap. How much did you know about the venture space before you saw this job ad?
Probably very little. Maybe a little bit. So I know David Swenson, the former CIO of the Yale Endowment, he had a lecture series online, which I had listened to beforehand. I'm not sure if it's still on YouTube, but well worth a watch if it is. So I knew a little bit about that, and Yale, obviously, David Swenson in particular, sort of really founded that sort of model of investing in more liquid assets, taking a very long-term approach, which definitely sort of helped some of the understanding. But really, it was not a lot was the answer. So for me, it was just a real nice opportunity to go into something new, and then you come out of that first job interview and you're sort of thinking, I've done some research and this sounded interesting, and now it sounds 10 times more interesting. Like, I really hope I go through to the next round. So yeah, it was a nice thing to stumble upon.
And you did, and you got in there. How has it been over the past 10 years? I can see how you basically gone up the ladder from an analyst to a director now. What has that journey been like over the past 10 years?
Yeah, it's really flown by, to be honest, and I think part of that is because it's been a lot of fun along the way. I think it's a really nice combination of being a job where I really enjoy the work, but then also we're a small company and I really like the people I work with. So anyone knows it's been a small company, and we're currently about 30 people at VenCap. It's probably a double-edged sword, where if you don't like the people you work with in a small company, it's probably pretty awful. But I'm lucky that wasn't the case for me. And I think the nice thing is that you sort of feel like you're always learning, because I've sort of, when people ask me what I do, I've sort of tried to distill it down to saying, look, I get to go around the world and look over the shoulders of some of the best investors ever. That's a really privileged place to be, because it's nice talking about the returns you get from being in an early round of OpenAI or an Anthropic in today's AI wave, or we were in Waymo, which if you ever go to San Francisco, I can highly recommend you taking one of those cars. But you get to sort of hear about those things before they're obvious, and most of the things sound quite outlandish, and you think, well, that founder's got massive ambitions, they probably won't get there. There's 60% of them will fail, but some of them don't, and some of them really sort of win in ways which really do, without any of the sort of Silicon Valley sort of hyperbole, like really do change the world. So it's been so amazing to be able to see some of that almost sort of firsthand, or at least being able to sort of see, a nice sort of view of what's going on, not just in the US, but also in Europe, in China, in India. Yeah, it's just been fascinating.
My family and I rode in a Waymo last summer in San Francisco, and I must say it is mind-blowing. Was smitten, my daughter was smitten riding in one. And thinking about it from your point of view, what does it feel like when, you see maybe a wild pitch, and then five, maybe three, maybe five, depending on how complex the technology is, you see it come to life. Can you describe what that feeling is like?
I think it's probably best crystallized when you look back at the old meeting notes. So, something like a Waymo is maybe like a great example where you can go viscerally in the vehicle and feel it. And the first time, again, you've just seen this coda when you sort of go and the steering wheel starts turning and there's no one there. Yeah, I don't think I'll ever forget that feeling. And you're thinking, this is something crazy. I remember, seeing the first SpaceX double synchronized landing. And that was, just sort of streaming it. And you're seeing the two rockets come down and land in perfect synchronicity upright. And you just look at it and you're going, that's something quite incredible. But even in the sort of more, in the software space, it's funny going back to the old meeting notes and seeing what was written at the time, because again, we're always 3 to 5 years too late to this stuff. So it keeps you humble when you read some of these. So, Facebook's a great example where we, I think Mark Zuckerberg was presenting at an annual meeting we went to, and there's a really sort of short comment about some guy in like jeans and a t-shirt, and then the Facebook, apparently kids were spending more time on it than they were in MTV. And that's the entire line about one of the best founders from a future $1 trillion company, one of the best founders the world has ever seen, in Mark Zuckerberg. And there's just this really short comment where you're going like, it's just some college kids on stage here. And not everyone is going to turn out to be a Mark Zuckerberg in terms of success, but some of them are. And the same is true for fund managers, because again, we don't do a lot of, or any first-time funds or emerging managers. We've got meeting notes where some people have come into our office and said, look, this is how we're going to access the best companies in the world. And you go, there's nothing here that will sort of, say that you've got the right to do that. There's nothing here, that will say you're going to do that. And then you fast forward 10 years and they do exactly that. So again, those sort of things like keep you humble, which I think is probably quite important in this business, because it's pretty easy to get carried away.
Very interesting. Over the course of this conversation, we've touched on two, I would say, almost opposite ideas, which is relationships and data. You came into this role from a data background, but you've mentioned in the past how you were surprised to see how much of a relationship role it is. How did you adapt, and how have you managed that balance over the past 10 years?
Yeah, I was sort of pretty shocked and a bit terrified when I just got the job with VenCap, with pretty much straight out of school, with a background in mathematics. And then my CIO goes, well, venture's all about the people. I was like, what? You just hired a maths graduate. And then I think for me, it was a real conscious effort the first couple of years, where I saw that, the people that were best at this job had the best networks and the best relationships. And I was thinking, I remember meeting some people early on, and bear in mind, this wasn't a high pressure meeting. This was going with a local VC who was roughly my age, who was a really nice guy, to the pub just to talk about venture, but I'd never really met him before, and I was terrified. The thought of going into a room where I knew no one, and say, I'm going to network and just talk to strangers for a couple of hours and tell them a bit about what I'm doing at VenCap. I've been here for a couple of months. That's what they're doing. Again, I couldn't think of anything worse. But I was lucky to have a couple of good colleagues who sort of went on that journey with me. We really sort of pushed each other to do it. And now it's one of the bits of the job where I actually quite enjoy, because I've met some incredible people the course of this job, whether they're LPs, VCs, founders, other players in the ecosystem. So it's sort of gone from something I was genuinely terrified of, to something which now sort of is one of my favorite parts of the job. I think you've got to sort of keep that grounding in the data and that sort of rigorous analysis, which that bit came really naturally for me, as you can imagine from the degree background. But I think balancing and putting both of those things together really helps, because even if you're having a conversations with someone about some whatever topic in venture, and you've got some great data to hand, some interesting analysis, or maybe something that disproves a common myth, that leads to a really interesting conversation. So the two work together really well. And again, talking to some of my friends, that are in the industry, if someone's a really sort of talented VC who spends all their day speaking to founders, they can obviously bring very different insights, which you can then go and see, does this sort of show up in our data? So the two things work together really well, but one of them required a lot of conscious effort on my part.
Thanks for that. Glad to see how you've evolved over the years. I mean, but with generative AI now, we've talked about your investments in the fund managers who've backed, some of these world-changing companies. How do you see your role, for one, changing? Again, maybe between that balance between data and relationship. How do you see that evolving for the next few years?
I think with using AI tools, and it's something we sort of focused on quite a bit within not just the investment team, but within the whole company, I think it should just give us the ability to do a lot more, because there was that that at a very high level you're saying if everything becomes 10 times more efficient, do you have 10x fewer employees, or do you do 10x more output? We're definitely trending towards the latter at VenCap. At least I hope we do for at least a couple more years. Yeah, fingers crossed. But we're seeing demos now of the capabilities of some of these products is just quite incredible. So as an example, we've got lots of international investors. There's always some documents you go, all right, well this document is in Dutch, say, and it's sort of a 5-page investment document. If I chuck that into ChatGPT, it will give me a very good translation instantly. Think about how that would have worked beforehand. Would we have to try to find someone to formally translate that? I mean, this may not be for something that's sort of critically important, so I probably just wouldn't have done it. And then you sort of say, oh, well, that's an avenue I'm just not going to go down in whatever sort of route of research I was taking. We're also sort of finding now that if you compare our organisation to 3 or 4 years ago, we've now got multiple people who are basically strictly data analysts, and that's sort of helping us to sort of get the most out of the data, because a lot of it comes in fairly unstructured formats. There's lots of which sort of quite hard to get into a format where you can say we can run sort of detailed analysis across different funds across long time periods. So just the shape of our organisation has already changed. And then being able to sort of use AI on top of that, either to collect the data, to clean the data, to provide sort of new outputs, will be really powerful. And just one last thing, just to give you an idea of something that's been happening in the last couple of weeks. We've been thinking a lot about how we produce our, we write a lot of decks, lots of presentations, and you're thinking, look, one, ChatGPT will give you very good feedback on how to improve getting messages across in presentations. When one of our portfolio companies on a look-through basis, Gamma, they will do the whole deck for you from a couple of prompts, and this is something we've started playing around with. It's both personal time and professional, but you can sort of see where the direction of travel is going. And then the thing I always think about is this is the worst this technology will ever be.
Yes.
You can take your view on how much better it will get over what time period, but it's already pretty good. So again, you can sort of see a world in the future where actually doing putting a presentation together, it won't be something that takes me or myself plus a couple of people, a couple of days to do. It will just be a case of, well, this will actually happen in a couple of seconds, but a lot more thought gets to be put into how to refine it, how to make sure the best things are coming through. So yeah, I think the rate of change is probably going to increase over the next couple of years.
Very interesting. I love Gamma. I use Gamma a lot for my presentation, so good to know it is one of your look-through portfolio companies. Just before we wrap up this section, if a young grad or an undergraduate came up to you to ask, you've seen you have this perch on the hill, so to speak. How would you advise someone young and ambitious? What would you advise them to study? What direction would you steer them, given where the world is going now?
In terms of what to study, if I look at myself, I studied mathematics because one, I was sort of quite good at it, I enjoyed it, and I sort of thought, oh, this is quite as someone that doesn't know what they want to do, this is probably quite a good broad subject to study. So again, I would give that same advice about thinking, what's going to be one, yeah, where do your aptitudes lie? Do you know what you want to do? Because if you want to be a doctor, then don't study mathematics. You should go to medical school. But thinking about what you're good at, and then I'd also sort of think about what's hard. Because I think one thing that is valuable, whether it's in terms of work experience, whether it's in terms of your studies, whether it's in terms of your other projects, people value people that have done difficult things. I think that's quite important as an abstract sort of point, and again, you can apply it to whatever you want. But when you sort of see the CVs of some of these world's most impressive people, it's just a list of really, really hard things. Whether it's elite sport, or you've done some PhD in philosophy, or whatever you want to do, they're all really hard things to do. Starting a company would be another obvious one. So I'd sort of think about what challenges do you want to spend a couple of years or maybe the rest of your life sort of working on, and then sort of really take it from there. Because I think that's probably a good way to do it. Because if you've done something that everyone knows is hard, that's always going to be valuable as an abstract thing, even if the thing that you do, maybe it's making presentations, maybe Gamma means that won't be as valuable a skill anymore. But if you worked 100 hours a week in an investment bank, that probably still will have some value, even if it's not just the actual task gets abstracted away.
I mean, I asked question for young students, maybe teens, maybe undergraduates. But honestly, your answer there is relevant even to my age, mid-career. So thanks for that. Maybe just some quick fire questions in wrapping up. You enjoying yourself? You're very good at what you're doing now. Do you ever see yourself flipping to the other side and building a startup?
At the moment, probably not. And I think it sort of goes back to, there's been nothing I've sort of come across and said, look, I have to drop what I'm doing and build that company. Maybe that happens. I don't know. It hasn't happened yet. So at the moment, I would say probably not.
Dan, thanks for that. Do you ever advise any founders between, taking venture capital versus bootstrapping, considering how risky and how much of a gamble VC funding is? And how do you advise founders deciding between bootstrapping and raising VC?
Yeah, I'd just say, if you're thinking about raising VC, make sure you're aligned to those goals. So if you're raising from a tier one manager, chances are it's not just a case of can you become a unicorn and $1 billion company, it's can you return $1 billion to their fund, which might mean becoming like a decacorn or more. Now that is a very rough approximation. Maybe someone with a different size fund or a different strategy will have different requirements, but know what you're getting into, because if you want to have a slow and steady, profitable, growing business, but you take capital from someone who wants hypergrowth, you're probably going to have a bad time. If you want hypergrowth and you set up your cap table with people who want slow, steady progress, again, it's probably not going to work.
That's, what you described there is something I definitely didn't know when I launched my startup, and I paid very dearly for it. Last question, what's the one piece of advice that has had the most impact on your career?
It's really hard to think about one piece of advice because there have been so many sort of great people that have helped me along the way. But I think one that does sort of stick out a bit is just the power of being consistent. So again, talking about building a network, it's not about being the most charismatic or extroverted person in the room. It's about will you follow up with these people on a regular basis for multiple years? And I think that is a really simple thing, has really sort of helped me. And again, it's also true in other areas. So if you consistently do what you say you're going to do, you'll sort of find that things sort of work out very well. It's not about being the most talented in any space. It's just being the most consistent. And that, again, is not always going to be true everywhere, but that sort of definitely, helped me a lot over the last sort of 10 years or so.
Thank you very much for that. I absolutely enjoyed speaking with you, and I'm sure our listeners will as well. Have a Merry Christmas as we come to the end of the year. Thank you very much, Sean.
Thanks, Lakota. I hope you have a great Christmas, and this has been a lot of fun.
Thank you.